Good afternoon, everyone. It's already 3 o'clock. Yeah, so I'm going to stop sharing the QR code. I'll share this again. Yeah, at around 4 o'clock. Okay. Good afternoon and welcome to this session. Yeah. Okay. Let us start the class now. Okay. So as you can see, one moment. Yeah. Okay. As you can see, we're going to look at some questions and selected, not all. Yeah. Excuse me, not all questions because we don't have time. Yeah, what I have done is I've selected questions in which more than half of the students have got the wrong answer. Okay, so where in questions where more than half of the students have got the right answer, these questions are not included. Okay, so I choose the more difficult questions. Yeah. So there are 19 questions out of 40, yeah, almost half. Okay, I've selected for this paper or for this session, yeah. So from this paper, so let's look at the first one. Can you all see the screen and can you all hear me clearly? If you can, then show thumbs up, please. All right, good. Okay, yeah. Let's start. Okay, this is question number 1. Let me just push this up slightly. Okay, yeah. Right, yeah, this is question 2 in your question paper. Which of the following questions involves a capital budgeting decision? That was the question, yeah? And you're given these options. How much inventory? Okay, this is about inventory, yeah? Inventory, as you know, is working capital. So it's not capital budgeting. All right, remember the 3 decisions in financial management. Okay, the first one is capital budgeting. As I said, the most important, yeah, is what you call arguably, yeah, capital budgeting, followed by capital structure, because that provides the funds for capital budgeting, and then working capital. All of them are important, but if you want to rank them in terms of the most important, then capital budgeting, yeah, because this gives you the long run return, yeah, for a firm, okay, or for a company, yeah, or for a business. So capital budgeting is the most important, yeah. Inventory is working capital, so this is not the answer, right? Then if you look at credit terms, yeah, credit terms will affect the receivables, okay, how much the customer owes the firm. This is also working capital, yeah, it is nothing to do with capital budgeting, yeah. So inventory, receivables come under current assets. They come under working capital. Therefore, B is also not the answer. If you look at C, yeah, should the firm purchase a new machine for the production line? Yeah, this new machine is fixed asset. Okay, therefore it's long-term investment. Yeah, this comes under capital budgeting. So C should be the right answer. What about D? Should the firm borrow money or obtain equity funds to acquire new equipment? Acquiring new equipment is capital budgeting, yeah, but how you fund the new equipment is capital structure. Okay, so this is capital structure decision, yeah, so D is also wrong, yeah, so C is the right answer. Okay, the answer is C, yeah. Okay, the cursor is not moving, yeah, do not know why. Okay, here we are, yeah. So this is the answer. Is everyone clear? Any questions? You can unmute your microphone and ask me now. Is this clear? Okay, more than half did not choose this. Okay, less than half chose this answer, yeah. The other half, more than half, chose the other answers. Okay, I'm surprised. It's a very simple question, yeah, and yet many students have got it wrong. Okay, can we move on to the next question? Okay, good. Let's go on to the next question. Next question is question number 10. Yeah. All right. The question is, which of the following is the correct formula for net income? Okay. Yeah. net income formula. There are many formulas, yeah, okay. Now, net income, is it EBIT minus tax? EBIT is earnings before interest and tax. Okay, if you minus tax, okay, you have not deducted interest. Yeah, net income is EBIT minus interest minus tax. So interest is missing here. Therefore, this is wrong. A is wrong. Yeah, is that clear, everyone? A cannot be the answer. What about B? Pre-tax income minus interest expense. Pre-tax is already after interest expense. Okay, pre-tax is after interest. Yeah, that means EBIT minus interest expense is pre-tax or earnings before tax. This is EBT. Yeah, EBT. So EBIT minus interest, you get EBT. Then you minus tax, you get net income. Yeah, so therefore this is also wrong. Yeah, pre-tax income minus tax, you can get net income, not interest expense. So this is wrong. Is that clear, everyone? So A and B, they are wrong, yeah? Cannot be net income. Is that okay? Okay, yeah? What about this? Operating income. Operating income is simply sales minus all operating expenses. Okay, you have not deducted interest expense. Therefore, this multiplied by 1 minus marginal tax rate is not the correct answer. Yeah, what if you multiply with 1 minus the marginal tax rate? There is a problem here. Yeah, let's say this is applicable if there's only one marginal tax rate that applies to the firm. Yeah, if there are many, then you cannot use marginal tax rate. Yeah, you need to use the average tax rate. Okay, for the firm. Yeah, the average weighted average tax rate. Yeah, so this may not be the right answer. Yeah, the main thing why this is wrong is that operating income has not deducted interest. Okay, operating income is sales or revenue minus all other operating expenses. Okay, therefore this cannot be the answer. What about this? D. Yeah, D is the correct answer. Yeah? If these three are wrong, then D must be the right answer. It is the right answer. Why? Because here, yeah, addition to retained earnings is retained earnings for the year. Okay, retained earnings for the year is net income minus dividend. Therefore, if you add dividends and retained earnings for the year, you will get net income. Okay, so net income, remember, net income minus dividend, you get retained earnings. Therefore, retained earnings plus dividends, you will get net income. Is that okay? So the answer is this. And many students did not choose this. Yeah, they chose one of the three here. Okay, less than half, yeah, chose this answer. Is that clear now? Any questions? If there are doubts, you better stop me and ask me now. Yeah, these are very fundamental knowledge. You need this even for the final. If you don't understand this, then you'll make mistakes in the final as well. Yeah. All right. Let's move on. Question number 11. Yeah. This is the question. Shafiq Parabot has sales of 760,000, cost of 630,000, interest expense of 21,000, and depreciation is 48,000. Yeah. The tax rate is 23%. What is the net income? Okay, yeah, so here, what is the net income formula? Do you remember the formula? Okay, yeah. Remember the formula for net income? What is net income formula? Net income is equals to sales minus cost of goods sold. But here, this is the cost, all the costs here, yeah? Costs minus depreciation, right? Minus, what else? Interest. Minus interest, then you minus tax. Yeah, minus tax, you can multiply this, all this, multiply 1 minus the tax rate. Is that okay? All right, yeah. Therefore, what you get here, you have the answer, yeah, which is, you can put 760. I'm just going to use the 760 here without the 3 zeros, yeah. 760 minus 630, okay, 60,000, that's the cost, minus depreciation, which is 48,000, yeah. Then minus the interest, 21, right? All this you multiply with 1 minus 23%. Okay, so what do you get here? Can you calculate? What's the answer? Can anyone give the answer? A. Okay. Ikram? Your microphone is on, yeah? Ikram? Can you switch off your microphone? Okay. If you want to answer, then you can unmute, yeah? But you just unmute and then not speak or let background news, it's going to disrupt us, yeah? So please remember that. Okay, the answer is, okay, the answer is this, yeah? A, yeah? 46,000. If you do this, if you use this answer here, if you do the working here, you get 46.97, yeah? In thousand, it will be 46,970 ringgit. Is that okay? Any questions? Are there any doubts here? Okay, yeah, you must know this is the income statement equation. Yeah, you start with revenue, you minus all the costs. You start with the operating costs, then you minus depreciation, then you minus interest. Okay, then you minus tax. But minusing tax is just like here, yeah, there's only one tax rate. Therefore, you just multiply with 1 minus the tax rate. Okay, this will be after the tax. Okay, so therefore, the answer is 46,970. Any questions? Is that clear, everyone? This is actually quite simple and straightforward. Any questions? Good. Okay, yeah, now we move on to question number 13. Now, here, the important pieces of information, yeah? What is this? This is sales. Okay, interest is given here, yeah? Interest, depreciation, cost of goods sold, they are not given in order, yeah? So you have to order it on your own, yeah? Dividends paid, administrative expenses, okay? The corporate tax rate is 22%, yeah? What is the addition to retained earnings? Now, addition to retained earnings is the symbol is retained earnings for the year, okay? So how do you get retained earnings for the year? This is net income minus the dividend. Yeah, we have already computed the net income, right? Just now in the previous question. So we use the same thing here, yeah? So here, retained earnings, you compute the net income first. Net income will be sales first minus cost of goods sold. What else? You minus the depreciation, yeah, or you minus administrative expense first, you minus all the expenses first, yeah? So this must also be deducted, yeah, administrative expenses, then you minus depreciation, then you minus interest, then you minus tax. Okay, but here the tax again is 22%, so you can multiply with 1 minus 22%, yeah. So you can multiply this, all of this, yeah, with 1 minus the tax rate. Okay, is that all? No, yeah, this is the net income, right? This is just the net income, yeah. You need to minus from this, you minus what? You minus dividend. All right, so if you do that, then what is the answer? Can you do that? So this is 50, the revenue, yeah, is 51,480. Cost of goods sold is here 21,840 minus administrative expenses 6,040. Depreciation is as depreciation, yeah, 3,960 minus the interest. Interest is 1,640. All this multiplied by 1 minus 22%, yeah, that is 78%, yeah, 78%. Then you minus the dividend of 4,200. Okay, so what's the answer you get? What's the answer? Anyone?
A.
Right. Okay, it's A, yeah, 9,840. Yeah, that's the answer for question number 13. Is that okay, everyone? Okay, yeah. So this here is similar to the previous question. The only addition is this dividend. Okay. Previous question was about net income. Here it's about retained earnings. Yeah. Right. But many students have got the answer wrong, yeah, for these questions. All right. Let's go to any questions for question 13 just now. Everyone clear? Okay. Yeah. Let's go to question 14 now. Fruity Florist Berhad has total sales of 911,400. Costs of, yeah, all costs I added here. So this is revenue. Okay, this is revenue. This is all costs. Okay, but depreciation is separate. Yeah, depreciation. Tax rate is 21%. Okay, it's all equity finance. What is the operating cash flow? Yeah, operating cash flow is OCF. Okay, what is the formula for OCF? What is the formula for OCF? OCF is EBIT. If you follow the formula, EBIT plus depreciation minus tax, right? Okay, yeah. Notice here, what is EBIT? EBIT is this, yeah, sales minus costs minus depreciation. Okay, you get EBIT, earnings before interest and tax. Yeah, but here because depreciation, yeah, you need to add back depreciation, you won't deduct. Yeah, so this, okay, if you take this is equivalent to, okay, sales minus costs. You don't have to add. Yeah, this minus this would be EBIT plus depreciation. So you don't have to add depreciation again. Yeah, I think many students did that and they got the answer wrong. Yeah, because sales minus the cost, okay, is earnings before interest and tax plus depreciation. It's already added. Yeah, so this is equivalent to this. Okay, remember, yeah, higher, if you deduct depreciation, your EBIT will go down. Yeah, and then you add back depreciation to adjust for the depreciation. You add back depreciation because depreciation is not a cash outflow. Okay, here, because you have not deducted, you don't have to add back. Is that clear? So you just need to take sales minus the costs. Yeah, this cost does not include depreciation. Yeah, all right. Now you minus tax. So how do you minus tax? Yeah, this tax is sales minus costs. Okay, minus depreciation. Sorry, yeah, you shouldn't put the bracket here. Yeah, minus depreciation. Okay, multiplied by the tax rate. Okay, so this will be your tax. Yeah, this whole thing will be your tax. Is that okay? Right, yeah. Here sales minus cost minus depreciation multiplied by the tax rate will be your tax. Okay, this will be your tax. Yeah. So this minus this will be your operating cash flow. Yeah, following this formula here. Yeah? It's the same formula. Yeah. Now this is equal to, you can take this common. Yeah. So we can take S minus C. Okay. This is 1. This is negative minus t. Yeah, so you can say this multiplied by 1 minus t. Okay, plus, why plus? Because it's negative, multiplied by negative, so it becomes plus. Yeah, plus depreciation multiplied by the tax rate. Okay, so there are two components here. Yeah, so you can replace. So this is the answer for operating cash flow. Yeah, this operating cash flow here is 911,400, okay, minus 787,300 multiplied by 1 minus 21%, yeah, 1 minus 21%, then plus depreciation, which is this 52,600 multiplied by 21%. Okay, this is called the depreciation tax shield. Yeah, this is called the tax shield. Yeah. So what is the answer? You replace the numbers here, you get the answer. What's the answer? Anyone?
Is it C?
Sorry, C.
C.
What about the others? Yes, yeah, the answer is C. Yeah. Okay. Everyone clear about this? Okay, this is using the formula. Yeah. If you're not very sure, you can actually calculate it out. What is the EBIT first? Calculate the EBIT first, then you plus the depreciation, you calculate the tax separately, then you minus the tax. You'll get the same answer. Yeah. If you, this formula is a bit mind-boggling. Okay, if you don't understand the formula, it doesn't matter. Calculate the EBIT. Calculate, then you add the depreciation. You calculate the tax separately, then you minus the tax. Yeah, it's a bit longer, but you get the same answer. Is that okay? Is that all right? Okay, good. Any questions? Okay, now we come to question number 15. Yeah, right here. Which one of the following statements related to corporate taxes is correct? Okay, yeah, let's look. That means if such a question, you have to go through all the statements, yeah, and see which one is correct. So let's look at the first one. Okay, let's look at the first one here. Additional income is taxed at the firm's average tax rate. Is this correct? Wrong. Yeah, why? Because additional income will be taxed at the firm's marginal, because it's additional. Okay, will be marginal tax rate. Yeah. So this is relevant if the company or the country, yeah, has different tax rates for different income levels. Okay, the tax rates are different for different income levels. Yeah, so this is wrong. So this keyword here should be marginal. Okay, now B, a company's marginal tax rate must be equal to or lower than its average tax rate. That is not necessarily true, yeah, because that's related to the answer that will come to D. Yeah, D is the correct statement. Yeah. Now, why it must be equal to or lower? It can be higher. Yeah, it can be higher. So it's not only equal to or lower. Yeah, it can be higher than the average tax rate. Yeah, it depends. So C, the tax for a company is computed by multiplying the marginal tax rate with the taxable income. This is also wrong. Yeah. Why? The tax for the company is computed. What is the formula for that? Okay. The formula for tax. Yeah. We take one moment. Yeah. I think I have to use the pen here. Yeah. Use the pen here. Okay. The tax. Yeah. This is the total tax to be paid by the firm. It is actually a summation. Yeah, I did not show you this formula earlier. It is the marginal tax rate at income level I multiplied by the taxable income at that level. Okay. Okay, I've shown you a table, yeah, using this. So it's a sum of the marginal tax rate plus the taxable income for that income bracket. Okay, so this you must add, yeah, it's a summation, yeah, from the income level, yeah, to n. Okay, so this is actually the formula. So the tax for a company is computed by multiplying, yes, multiplying, but it's a sum, yeah, of the product of these two. Okay, and therefore this statement is inaccurate. It's not complete. Okay, so this is wrong. Yeah, this answer is wrong. Yeah, the correct answer is this. Yeah, because it's similar to this. The marginal tax rate for a company can be either higher, lower than, or equal to the average tax rate. So this is the correct answer. Yeah, it can be higher or lower or equal. Sometimes it can be equal. Yeah, okay, it can be equal as well. So this part is correct. Okay, equal to or lower than. Only lower than is not accurate. Yeah? It can also be higher than. So B is also wrong. Is that okay? Any questions? A is wrong because this should be marginal tax rate. Is that okay, everyone? Any questions? Okay, good. This is the right answer, yeah? D is the right answer. Now let's look at question 17. Can you all see the screen clearly? The color, is the color too dark or is it clear? Okay, yeah, good. All right. Now, according to the statement of cash flows, an increase in inventory will what the cash flow from what activity? So this is a question about statement of cash flows, yeah? Now, the given information is increase in inventory. Okay, inventory is working capital, right? Now, working capital must be from operating. Okay, it's either A or C. Yeah, financing, no way. Yeah, this is wrong. Yeah, so B and D is definitely out. You know this inventory. Now, increase in inventory is a cash outflow or inflow. It is an outflow. Yeah, so this will decrease. Yeah, decrease the cash flow from operating activity. If you increase your inventory, you use cash. Yeah, that is why it is decrease the cash flow. Cash outflow means you decrease the cash flow. Yeah, so it's a cash outflow from operating activity. Cannot be increased. Yeah, you increase inventory by using the cash. Yeah, you use the cash to purchase the inventory. Much more cash will be tied up as inventory. Therefore, it is a decrease, not an increase. This is wrong. Is that okay? Any questions? Is that clear, everyone? Okay, yeah. So the answer is this. Now, next question. Can we move on to the next question? Okay, yeah. Question 20. Brainy Brooks. Yeah, Brainy Brooks has a debt equity ratio of 0.57. What is the total debt ratio? Yeah, we have covered this in class. Yeah, not exactly this question, but a similar question, right? So we want to get total debt ratio. Yeah, total debt ratio is debt over assets, right? Now, this debt over assets, you are given debt over equity. Note that, yeah? Therefore, we expand this debt over debt plus equity. Okay, because assets is debt plus equity. Yeah, we use D here rather than L. Yeah? It's the same thing actually. You can use L for liabilities or use debt for D for debt. Doesn't matter. Yeah. All right. Now what do you do? Because you are given debt over equity, you get debt over equity if you divide all the elements with E. Yeah, you divide the numerator and the denominator by E. Yeah, so what do you do? This will be equal to debt over equity divided by debt over equity plus equity divided by equity, right? Okay, yeah, so this is exactly the same as this. Okay, therefore, this is debt over equity divided by debt over equity plus 1. Therefore, this is 0.57 divided by 0.57 plus 1. All right, what's the answer then? Which is the answer? A. Anis says A, yeah? Yes, the answer is A, yeah? It cannot be the other answers, yeah? Especially this, yeah, total debt ratio. Can it be this? Okay, yeah, you can actually, by elimination, yeah, total debt ratio must be less than 1, yeah? It cannot be more than 1. So these two are actually wrong, yeah? Without even calculating, yeah, you know that these two are wrong. Okay, total debt ratio cannot be more than 1, yeah, because it is debt over assets. Debt cannot be greater than assets. Okay, so therefore this is wrong, yeah. So either A or B, yeah, but this is how you compute or calculate. Any questions? Is that clear, everyone? Okay, now let's go to question 21. Okay, which of the following statements is correct? Okay, here, yeah. So you have to read through all the statements. Yeah, let's look at the first one. If the debt equity ratio is equal to 1, then its total debt ratio must be equal to 0.5. Is that correct? Okay, yeah, look at this, 1 to 1. Yeah, that means $1 of debt for $1 of equity. Then you get 1. Okay, if it's $1 of debt and $1 of equity, then the debt ratio must be 1 over total assets. 1 plus 1 is 2. Yeah, 1 over 2 is 0.5. So this is correct. Okay, this is correct. Okay, okay, what about the others? Okay, an increase in depreciation expense will directly affect the cash coverage ratio. Okay, yeah. Now, this is where many students make mistakes. Cash coverage ratio, what's the formula? It is EBIT plus depreciation. Okay, this 2 divided by interest, right? Okay, yeah. So an increase in depreciation means if this goes up, then CCR will go up. Okay, is it true? Wrong. Yeah, why? Because if this goes up, okay, the EBIT will go down. Okay, remember that. Yeah, if depreciation is after EBIT is after deducting depreciation. Okay, so if depreciation is higher, EBIT will be less. Okay, if depreciation is higher, so this amount here will not change. Okay, this amount, yeah, will not change due to depreciation expense changes. Okay, this will remain the same. Yeah, therefore CCR or cash coverage ratio should not change just due to depreciation. Is that okay? So this is wrong. Yeah, this answer is wrong. Many students, I think they just use the formula and say if this goes up, this is constant. They assume this is constant. Cannot. Yeah, if this goes up, this will go down. EBIT will go down. Yeah, if this goes up, this will go down. So these two, when you add these two, they will not change. Is that okay? Everyone clear about this? I think this is where many students make mistake. Am I right? Many students felt that this is correct. Yeah, this is wrong. Yeah. Okay. Now, let's look at C. An equity multiplier of 1.25 means a firm has $1.25 or ringgits, yeah, in sales for every $1 of equity. Is this correct? Wrong, yeah? Why? Because this is assets. Okay, it's 1.25 equity multiplier. Remember, equity multiplier, the formula is A over E, yeah? $1 of equity, how many dollars of assets, not sales, yeah? So this is wrong. Is that okay? Everyone clear? This C is also wrong, yeah? What about D? Long-term creditors would prefer organizations that have times interest ratio of 1.5 rather than 2.5. Is that true? Wrong, yeah? 2.5 would be better because they have more income, yeah, to service a given interest expense, yeah, or interest cost. This one has less income, yeah? Long-term creditors would look for higher ratio of times interest earned, not lower, yeah? So this is also wrong. Is that okay? Any questions? So the answer is A. Any doubts? Is that okay, everyone? Okay, good. Let's move on to question number 22, yeah? Right. Now here, Swiss Berhad managed to increase sales of goods while keeping inventories at a constant level. Assume both unit cost and unit selling price also remain constant. This achievement will be reflected in the company's financial ratios in which of the following ways? Okay, yeah. So if you look at this is about inventory, okay, constant, and increase sales. Okay, sales of goods, yeah, that means cost of goods sold, yeah. You can take sales or cost of goods sold, yeah. Okay, this has gone up. Inventory is constant, okay. This sales of goods sold has gone up. So therefore, what happens? The turnover rate, will it go up or go down? There are two, and this is turnover rate, okay, but this is fixed asset. So this has nothing to do with fixed asset. Yeah, this is wrong. Yeah, okay. So you have inventory here. You have inventory here. What about this net working capital? This has nothing to do with. Okay, it has something to do, but here it only talks about inventories. Yeah, net working capital has many other what do you call assets. Yeah, not only inventory. So this is not correct. Cannot be correct. Okay, this cannot be correct. Yeah, or there are many other aspects not covered in the question for net working capital. So this is not the answer. Yeah, it has to do with this. Yeah, these two, A or C. Now, if sales increases and inventories remain the same, will the inventory turnover increase or decrease? It will increase, yeah, because the formula for inventory turnover is you can take cost of goods sold divided by inventory. Okay, so inventory is constant, cost of goods sold goes up, so this will go up. Okay, this increases, this remains constant, this inventory turnover will go up. Okay, so this is wrong. Yeah, decrease is wrong. These two is out, therefore this must be the answer. Yeah, but let's look at the question, the option here. Decrease in the days sales in inventory. Now, days sales in inventory is the reciprocal of inventory turnover. Yeah, so if this decrease is wrong, this decrease must be correct. Yeah, so this is correct. Remember, day sales in inventory is inventory over cost of goods sold multiplied by 365. Reciprocal, yeah. Inventory is constant. This goes up. This one is already constant, yeah, 365. Therefore, this will become lower. Yeah, this is constant. Greater the denominator, this will decrease. So this is correct. Is that okay? Any questions? So the answer is C. Okay, yeah. Any questions here? Okay, now question number 29. Okay, using the percentage of sales approach in financial planning, if a firm is operating at full capacity and has a fixed dividend payout policy, which of the following will not normally change in the same proportion as the change in sales? Now, if the company is operating at full capacity, if there's a change in sales, fixed assets will also change in the same proportion. Okay, it will vary directly, yeah, because it's full capacity. If you want to increase your sales, you must increase your fixed assets at the same capacity, yeah, or the same proportion. So A is not the answer. Yeah, we want to choose that will not normally change. So this is wrong. Yeah, this is not the answer. Okay, what about we leave out depreciation? Yeah, come to current assets. What about current assets? Current assets and cost of goods sold these are normally assumed to change in the same proportion as the change in sales. Yeah, remember in percentage of sales approach in financial planning, current assets and cost of goods sold. These two, and this is the income statement. Okay, this will change in the same proportion. Current assets is in the balance sheet. Yeah, these two must change in the same proportion with sales. Okay, if sales go up by 10%, these two must also go up by 10% according to the percentage of sales approach. Is that okay? Right, yeah. So these two will change, and just like fixed assets, yeah, because fixed assets at full capacity will also change, yeah. So these three are not the answer because we want to choose not, yeah, not, yeah. So all these three are wrong answers, yeah. All right. Therefore, what about depreciation? Depreciation will not depend on the change in sales. Yeah, depreciation will depend on purchased fixed assets in the previous term, yeah, current year or the previous year. Therefore, this will not normally change with sales. Okay, because this is not dependent on the projected sales. Yeah, it is dependent on what you have purchased previously, fixed assets, yeah, that you have purchased previously. Therefore, this is the correct answer. Is that okay, everyone? Okay, that's the answer. Yeah. Okay. Any questions here? Right. Let's move on to question number 30. Yeah. Now, a firm's current year sales is 6 million, its profit margin is 20%, and its dividend payout ratio is 30%. Yeah. If the sales is expected to grow next year by 10%, what is the firm's retained earnings? Yeah. Now, this is the current year sales. We can use as subscript O. Okay. The profit margin, this is PM, profit margin. The dividend payout ratio is D. Okay, this is 30%. If the sales is expected to grow next year by 10%, this is G. Okay, the growth rate. Yeah. Now, what is the expected retained earnings for next year? That means you need to get RE, retained earnings, subscript 1. Okay, that means next year. Yeah. So how do you compute this? This, yeah, retained earnings will be the sales for next year. Okay, sales for next year, yeah, 1, not 0, yeah, 1 multiplied by the profit margin. Okay, the profit margin is supposed to be constant. Okay, this year or next year will be the same, yeah, profit margin. So this is the sales for next year multiplied by the profit margin. This will give you the net income for next year. Is that okay? This is net income for next year, yeah, net income next year, 1, yeah. So from this, okay, you need to minus, because retained earnings is net income minus dividend, right? Now, dividend, you know, is because the payout is fixed, you multiply, yeah? The retained earnings is, you multiply this net income with 1 minus the dividend payout ratio. This is also fixed. The profit margin is fixed, yeah? So you know this, yeah? What is the sales for next year? Sales for next year is sales for this year, S1, yeah? Is 1 last, yeah? This is the current year sales multiplied by 1 plus the growth rate. Therefore, this, yeah? This thing, you expand to this, okay? Therefore, you multiply with the profit margin, then you multiply with 1 minus T, yeah? So that will be your retained earnings for next year. Therefore, this is 6 million. Okay, we can put 6M here for short. 1 plus 10%, 1.1, okay? Multiplied by the profit margin, which is 20%, 0.2, multiplied by 1 minus 30%, yeah, or 0.7, yeah? What's the answer? What is the answer you get for this question number 30? Is everyone clear? The working?
The answer is C.
Sorry?
C. The answer is C.
The answer is C, okay? Right? Can you all see the working clearly? Yes? The answer is C, is it? Wrong, yeah? The answer is not C, yeah? The answer is B. Okay? Right, yeah? This is 6 million multiplied by 1.1 multiplied by 20%, 0.2 multiplied by 0.7, yeah? You get, okay, 624, okay? 624,000 ringgit. Or you get 0. You use 6 million here, you get 0.624. Is that okay? Everyone clear? I've shown you the working as well.
Sorry, Prof.
Yes.
Why it's not 30%?
What 30%?
The dividend.
Dividend is 30% here.
But in the calculation, you said 70%.
No, dividend payout ratio is 30%, right?
Yes.
Okay, if you pay out 30%, what you retain? Remember the earning here is expected retained earnings. How much do you retain? If you pay out 30%, you retain 70%, right?
Yes,
So
I
this
understand.
is 1 minus 30% is 70%. Is that okay, Alif?
Okay, okay. Okay, sir.
Right. Any other questions? Is that clear? So the answer is B, yeah? Is that okay? What is the time now? 3:50, yeah? Okay, let's move on. Now, in financial planning, using this question number 31, yeah? In financial planning, using the percentage of sales approach, if the firm is operating at less than full capacity, which of the following will usually be assumed to change in the same proportion as the change in sales? Okay, now note that it is operating at less than full capacity. Okay, not full capacity, yeah? Okay, which of the following will usually be assumed to change in the same proportion? Okay, now let's look at cash, yeah? Cash is part of current assets. Current assets, yeah? So if sales increase, cash will also increase in the percentage of sales approach. It will, yeah? So this should be the answer. What about equity? Equity will depend on the dividend policy. If you pay out more, then you will retain less. Okay, so this will not change in the same proportion as the sales. This is not the answer. Yeah, this will depend on the dividend policy. Yeah, it is not dependent on the sales. When you change the dividend policy, the funding from equity, yeah, will change, right? Therefore, it's not dependent only on sales, yeah. So this is not the answer. What about fixed assets? Because it's operating at less than full capacity, fixed assets will not change, okay, at the same proportion as the change in sales. Only current assets will change. Yeah, we have seen that in chapter 4. Okay, so this is not the answer, cannot be the answer. Yeah, if this this company is operating at full capacity, then this will be the answer. Okay, this will also, yeah, not the answer, but this will also change in the same proportion as sales. Is that okay? What about short-term debt? Now, short-term debt is discretionary debt. Okay, it's not payables. Yeah, if it's payables, okay, let's say creditors. Yeah, from not creditors, sorry, suppliers. Yeah, okay, credit from suppliers. That will be spontaneous liability. Yeah, so spontaneous liability will change in the same proportion as sales. Yeah, in percentage of sales approach. Short-term debt is discretionary, yeah? Therefore, this will not change in the same proportion with sales. Therefore, the only answer is A. Is that clear, everyone? Any questions? Okay, yeah. Now we move on to question number 32. Okay, a firm's capital intensity ratio is 1.25 times its spontaneous liabilities fund 10% of its assets. Okay, if its sales is 8 million this year and is expected to grow by 15% next year, what is the expected amount of spontaneous liabilities next year? Okay, so here we are looking at spontaneous liability next year. Yeah, spontaneous liability next year, 1. Yeah, so how do you get this? Okay, this, yeah, will be based on, yeah, this will be based on the new level of sales. Yeah, we take S1, okay, multiplied by the capital intensity A divided by S. This is the reciprocal of the total asset turnover. Okay, this is capital intensity. Yeah, capital intensity is this A over S. This is total assets over total sales. Yeah, it's 1.25 times. So if you need more assets to do support $1 of sales, then your assets, yeah, will also be higher if your projected sales is higher. Okay, so this will be the total assets, yeah, required. This will be A1, yeah, or total assets required in the coming year. Okay, now from this you multiply with the spontaneous liability, yeah, spontaneous liability over assets. This is given here, yeah. Spontaneous liabilities fund 10% of its assets. So this is here, yeah, right. But you know what is S1? S1 is equal to SO multiplied by 1 plus G. The current level of sales is given, okay, 8 million. That is SO. 1 plus G, G is 15%. So you know that this will be S1. So you multiply with, okay, let's put in the numbers here, yeah. This is 8 million multiplied by 1.15. Yeah, this is the growth rate. Yeah, 1 plus 15% is 1.15 multiplied by the capital intensity ratio 1.25 multiplied by, this is the spontaneous liabilities. Yeah, this is 0.1. Okay, 10%, right? Therefore it's 0.1. So this will be your answer. Yeah, the expected amount of spontaneous liabilities next year will be this. Okay, what is the answer? Can you get the answer?
The answer is A.
Okay, yeah, the answer is A, correct. Is that okay? Now, does this make sense? Right, yeah. Okay, any questions? Is that clear, everyone? Can we move on to question number 33? Okay, good. All right, here again, capital intensity ratio is 0.8. Okay, the firm is operating at 90% capacity, not full capacity, yeah? Its current assets make up 40% of the firm's total assets, yeah? So current assets, yeah? Sales this year is 54 million, right? Sales next year is expected to grow by 12%. Okay. Now, what is the expected fixed assets next year? Okay, fixed assets next year is FA1. Okay. Now notice, what is this? This is A over S. This is the capital intensity ratio. A, yeah, sorry, A. Okay, then this is the operating capacity. We can use the symbol K. Remember, I've used the symbol K in the class. K stands for the operating capacity. Yeah. Now this is current assets. Okay, current assets over total assets. Yeah, we can use this as CA, current assets over assets. Okay. Now this is SO. Okay, the sales for the current year, and this is G. Okay, 12%. All right. Now here, what is the fixed assets for the coming year? Yeah. Now this will be the fixed assets for the current year divided by full capacity sales. Okay. We need to work out what is the fixed assets for the current year. Yeah. And we divide this by full capacity sales. Why? Because right now, these fixed assets are not used fully. Okay, so we need the full capacity sales, yeah, to get the ratio, yeah, right. So this, okay, multiplied by the projected sales for next year. Okay, this will be the equation, yeah, this will be the fixed assets for next year. It will depend on the projected sales for next year multiplied by the ratio of fixed assets required per dollar of sales in full capacity sales. Is that okay? Right. This is the basic equation. So we need to expand this. Yeah. First, what is this? Fixed assets. Yeah. Fixed assets will be okay. Here, yeah, we take asset over sales. This is the capital intensity ratio multiplied by the current sales. Okay, this will give you the current total assets. Okay, this will be AO, yeah. Then you multiply with 1 minus CA over assets. Okay, now 1 minus CA over assets, this is the current assets, yeah, proportion of current assets over total assets, right? So if you minus 1, this will be your fixed assets. This will be total assets, then this will be the proportion of fixed assets. When you multiply, you get the fixed assets for the current year. Is that okay? All right. This whole thing. This is actually the whole of this. Okay. Right. Yeah. Then you divide this by full capacity sales. How do you get full capacity sales? SO, the current level of sales, divided by K. Right? Remember this, yeah? This is the current level of sales, 54 million divided by K, yeah, which is 90%. Okay. Then don't forget, multiply by here S1. S1 is SO multiplied by 1 plus G. Okay, now you know all the figures. Yeah, you just replace. Okay, so this is AOS is 0.8. Okay, let me write it here, 0.8. Okay, that is the capital intensity ratio multiplied by 54. Actually, you don't need to write 54 here. Yeah, why? Because you can cancel this off. Yeah, so let's not write that here. Okay, you can cancel this off. Yeah, you multiply with 1 minus, this is multiply. Yeah, 1 minus the current assets ratio. Yeah, current assets per total assets ratio, which is 40%, or 0.4. Yeah, we put 0.4. 1 minus 0.4, which is this. Okay, this multiplied by this, divided here. Yeah, divided by SO, we can cancel these two, but note that this is divided, this divided by K, and therefore it's equal to multiplied by 90%. Multiplied by K. Yeah? If you bring this over, becomes multiplied by 90%, or 0.9. Yeah, you can write this as 0.9. 0.9. So that will be on top. Then you multiply with, again, yeah, you continue here, 54, multiply by 54 here, 54 million, this, multiplied by 1 plus G, yeah, 1 plus 12%, or 1.12. Okay, all this, okay, when you calculate, okay, there's no division. Yeah? This becomes multiply. So if you multiply all this, you get the answer. So what's the answer? Can you try this? 54 multiplied by 1.12 multiplied by 0.8 multiplied by 1 minus 0.4, which is 0.6. Yeah, multiplied by 0.9. Yeah, so you get the answer. What's the answer? Yes, that's right. Yeah, 26,127,360. Okay, this is just using the numbers. Yeah, but you can actually break it down. Yeah, you can use the method that I've shown you in class. You can work out what is the total assets. You go step by step. Yeah, total assets, the current total assets, the fixed assets. Yeah, the current fixed assets, the current assets, and then the projected sales, full capacity sales, and so on. Yeah, you can go step by step and you get the same answer. The answer will be the same. Is that okay? Any questions? Is that clear, everyone? Okay, I think among all the questions, this is the toughest. It may take longer. And there was only one question like this. Yeah, all the others were quite simple. Actually, this is quite simple. You can, if you understand the concept, you can do it in one line. Okay, if you don't understand the concept, okay, then it'll be difficult. Yeah, even if you do not know how to do it this way, you can work it out, yes, through several lines. Okay, but this is the most challenging question in the paper. All the others were quite straightforward. Okay, any questions? Is that clear? Everyone clear how to get this answer? Okay, yeah. Now let's look at question number 34. Okay, a firm is currently operating at full capacity. Net working capital costs and all assets vary directly with sales. The firm does not wish to obtain any additional equity financing. Yeah, this is important here. Okay, the dividend payout is constant. Okay, dividend payout is constant. Yeah, all right. And the firm has a positive EFN. Okay, external financing needed. Okay. Okay, now this will be met by what? If you have EFN, how will it be met? Okay, will it be met by fixed assets? No, yeah. EFN refers to you need financing. You need financing to support your fixed assets, yeah, and other assets, yeah. So it cannot be met by fixed assets. So this is definitely wrong, yeah. Okay. So remember, EFN is met by only external, yeah, because it's external equity or debt. Okay, it has to be external equity or external debt. So it can be debt here. Long-term debt is external debt. Accounts payable, can it be? No, yeah, accounts payable is spontaneous liability. Spontaneous liability is not part of external financing. Yeah, so this is also wrong. Yeah? Why? Because this will automatically change with sales. Okay, even if you want more financing from accounts payable, it's not possible. Yeah, because this is considered to be autonomous, yeah, meaning it is spontaneous. Okay, changes together with sales, yeah. So that this is not part of EFN, yeah. Now, what about retained earnings? Retained earnings is internal equity. So this is also not part of EFN. Yeah, if this is internal, how much you retain? This will depend on your dividend policy. Okay, dividend payout. You pay out more, you will retain less. If you pay out less, you will retain more. So this is dependent on your dividend policy. Yeah, it does not affect. It affects, but this will not influence your EFN. EFN cannot be met by retained earnings. It has to be external. So external debt and equity. Yeah, but you here it says you do not want to have additional equity. Additional here means external equity. If you don't want equity, you can only use debt. Okay, so only debt option available here is long-term debt. Yeah, even if it states this as short-term debt, this will be the answer. All the others are wrong. Yeah, because you don't use fixed assets to meet your external financing needed. You don't use accounts payable. You don't use retained earnings. Okay, you can use debt. Okay, or you can issue new equity, but here you do not want new equity. Therefore, you can only use long-term debt or short-term debt. Okay, so here long-term debt is given. Therefore, long-term debt is the right answer. Is that okay, everyone? Is that okay? All right. Yeah, it's already past 4 o'clock. Yeah, it's more than 1 hour. Okay, we have a few more questions. Yeah, just a few more. Okay, 3 more questions, yeah, including this. Okay, now the D Green Group has a 5% profit margin, 67% dividend payout. The total asset turnover is 1.5 times and the equity multiplier is 1.8 times. What is the sustainable growth rate? Okay, you remember the formula for SGR, sustainable growth rate? This is ROE multiplied by 1 minus D divided by 1 minus ROE multiplied by 1 minus D. Okay, but yeah, this is the answer for SGR. Yeah, you're not given ROE directly. So ROE here, okay, we have seen earlier in chapter 3. Remember the DuPont analysis? ROE is profit margin multiplied by total asset turnover multiplied by equity multiplier, right? These three components. So you can replace that here, yeah? You can put this ROE, you replace with this. It's PM, profit margin, multiplied by total asset turnover, multiplied by equity multiplier, then multiplied by 1 minus D. Okay, now all this minus, yeah, minus from 1, yeah, multiplied by EM, okay, multiplied by 1 minus D. You replace this, okay, you know profit margin is 5%, total asset turnover is 1.5, equity multiplier is 1.8, multiplied by 1 minus 0.67, yeah, you get 0.33 here, okay. So all this divided by 1 minus that. Yeah. So what's the answer? What's the answer you get for SGR? Okay, the answer is 4.6627%. Okay, that's the sustainable growth rate. Okay, any questions? Okay, quite straightforward, yeah? Not difficult, right? It's simply application of what we have learned earlier, yeah? Right. Any questions here? Right. Now we move on to the last two questions. Yeah, the first one is here. At 8% compounded annually, how long will it take for your money to increase by 100%? Okay, yeah, 100% here means, okay, yeah, what are the known elements? It's a very simple time value of money problem. Okay, increase by 100% means what? It's just like doubling, yeah, your money. Yeah, therefore, future value will be 2 times the present value. So we know the future value, we know the present value, and we know the interest rate. Okay, we know the interest rate is 8%. Okay, so what is unknown? Unknown is n. Okay, now how do you solve for n? Remember the formula that we have seen? It is the natural log of future value divided by present value. What is the future value divided by present value? This divided by present value will be 2, right? Okay, yeah. So divided by ln, natural log of 1 plus r. Therefore, this is natural log of 2. Okay, future value divided by present value is 2. Yeah, why? Because it increases by 100%. Yeah, future value is 2 times of present value. Yeah, so this divided by natural log of 1.08. Yeah, 1 plus 8%. Yeah, so what's the answer? A, correct. Yeah, it is 9.00 something. Yeah, so it rounded off to 9 years. Yeah, so if you are investing your money for at 8% interest per year, you have to wait for more than 9 years, yeah, to double your money, okay, from the interest. Is that clear? Any questions? All right, now let's move to the final question, yeah, question number 40. Right, yeah. Now, Tanya invested 25,000 in an account that pays 4.5% simple interest. How much more could she have earned over an 18-year period if the interest was compounded annually? So what do you know? Yeah, again, the elements that we know. This is present value. All right, 4.5%. This is simple interest, but okay, you know that this can also be compounded. Yeah, so it can be simple interest and compound interest. Yeah, this is the interest rate R. Yeah, right, and you know the term N. Okay, right. So what is unknown here? Yeah, okay, first you need to know the future value with compound interest C. Okay, and you need to know the future value with simple interest S. Okay, yeah, what is the formula for compound value? Future value with compound interest is present value multiplied by 1 plus r raised to the power of n, right? It's a basic simple, yeah, future value formula. Now for simple interest, it'll be this, yeah, the present value multiplied by this is 1 plus r multiplied by n. It's a difference here, yeah. So here the question is, how much more could she have earned? That means it must be future value with compound interest minus future value with simple interest. Is that okay? Now this is equal to, because this is common, okay, we can bring this out, okay, outside, okay, we can put this. So this, yeah, which is 1 plus r raised to the power of n minus, okay, 1 plus r multiplied by n, okay, right, yeah. So you can replace this as 25,000. This is 1 plus 4.5 or 1.045 raised to the power of 18 here, minus 1 plus, this is 0.045, note this, yeah, 0.045 multiplied by 18, okay, this, yeah, then you add 1. So the difference between this, multiply with 25,000. Okay, so what's the answer? Is everyone clear about this working? This is the future value. Okay, if Tanya has invested, yeah, the 25,000 in compound interest, same interest rate, yeah, 4.5% per year, but it's compound interest. This is future value, the normal future value formula. This is the simple interest rate future value formula. Is that okay? So the difference between the two, right? So what is the answer? B, yeah, right? What is the answer? Correct, B, yeah. It is $9,961.97. Is that okay? Okay, yeah, this is 1.045 raised to the power of 18, yeah, minus this, you multiply first, then you add 1, yeah. So the difference between these two, you multiply with 25,000, okay? So you get this answer here. Is that okay? Any questions? Okay, with that, we finish this topic. Yeah, let me stop sharing now. Okay, I'm going to share the screen. Yeah. Okay, this is, let me share both screens. Right. Okay, those who have not scanned the QR code for attendance, please scan now. I'll give you a few more minutes. Yeah. Okay, I'm going to stop recording. Are there any questions you can ask me now before I stop recording?
Sir, can you add manually?
Okay, you let me add manually later. You send me a message in the WhatsApp group.
All right.
Please mention your group and your metric number. Okay, was the session useful? Did you learn something new? Did you learn your mistakes? Everyone has, many have already left, yeah? Okay. Okay, I hope you won't make the same mistakes again, yeah? In the final, you will have multiple choice questions as well, yeah? So there will be some calculation questions in the multiple choice, yeah? So please be prepared. Okay, I'm going to stop recording now.